If you search online for Forex trading in India, you will probably hit a wall of warnings telling you the practice is entirely illegal. But the reality is a lot more specific. The market is open to Indian residents, but it is strictly regulated. Step outside those boundaries and the consequences get severe fast. Overseas brokers know exactly how to tempt traders. They market aggressively to Indian residents, dangling access to exotic currency pairs and extreme leverage, sometimes offering ratios as high as 500 to 1. Here is the absolute legal line. Trading spot Forex or contracts for difference through any platform based outside of India is a direct violation of federal law. Because these offshore platforms operate completely outside Indian jurisdiction, you have zero investor protection. If the broker goes bankrupt or decides to freeze your withdrawals, you have no legal recourse to get your money back. All that convenience and extreme leverage acts as bait. Falling for it turns standard market risk into a massive legal liability. This is the headquarters of the Reserve Bank of India. The RBI acts as the ultimate gatekeeper, tasked with defending the nation's financial stability and its foreign exchange reserves. If millions of retail traders started wiring unlimited funds offshore for speculation, it would trigger massive capital flight and aggressively destabilize the value of the rupee. To prevent that, the government relies on the Foreign Exchange Management Act of 1999. FEMA operates on a very strict baseline principle. Every single foreign exchange transaction is illegal, unless the government explicitly permits it. There are legal channels for moving money, like the liberalized remittance scheme. The LRS allows Indian residents to send up to $250,000 abroad per year for approved reasons, like education or medical care. But there is a crucial exception written into the LRS. Sending funds abroad to cover margin calls or to bankroll speculative Forex accounts is explicitly blacklisted. As this flowchart shows, routing your money through a different digital pipe, like crypto, an e-wallet, or a third-party processor, does not mask the underlying transaction from the authorities. Technological tricks do not erase your liability. Under FEMA, the legal burden and the crime remains entirely attached to you, the resident Indian. When those illegal transactions are flagged, the case goes to the Enforcement Directorate, the federal agency responsible for prosecuting FEMA violations. If you remit $5,000 offshore, the ED can levy fines up to 3 times the amount, a $15,000 penalty. The multiplier is based on capital moved, not profit. If you lose the initial investment, you are liable for the full penalty. The consequences escalate from there. The government has the authority to impose continuous daily fines and seize your equivalent domestic assets, draining your local bank accounts or confiscating physical property. For severe offenses, or if you simply fail to pay the levied penalties, the law even includes provisions for civil imprisonment. Participating in unauthorized offshore Forex is a high-risk gamble that can permanently dismantle your financial reputation and your personal freedom. Fortunately, there is a legal path. You can trade in a strictly regulated domestic sandbox overseen by the Securities and Exchange Board of India. The mechanical difference comes down to what exactly you are trading. While Indian residents cannot legally trade spot Forex, they are fully permitted to trade currency derivatives, specifically futures and options contracts. This split-screen diagram shows why. Unlike an illegal spot trade where capital bleeds out of the country, derivative contracts function safely within the domestic system. Every trade is entirely settled in Indian rupees, preventing capital from ever crossing the border. This legal trading takes place on recognized domestic financial hubs like the National Stock Exchange. By utilizing SEBI-regulated derivatives on these domestic exchanges, you get the analytical thrill of global currency speculation without triggering any federal alarms. The menu of allowed instruments is restricted. Traders are limited to specific pairs that involve the Indian rupee, such as USD to INR, UR to INR, and JPY to INR. There are also legal exceptions for pure global markets. A few major cross-currency pairs, including UR to USD and GBP to USD, are legally permitted, as long as they are traded as derivatives. Before making any deposits, you have to verify your broker. Always demand and verify their official SEBI registration number. You also need to confirm that the broker is an authorized member of the currency derivative segment on recognized platforms like the Bombay Stock Exchange. A sustainable, long-term trading career in India requires you to focus on mastering market analysis and risk management, rather than burning your energy trying to dodge federal investigations. Rely on verified, transparent platforms. Utilize resources from FXNX to master currency derivatives and execute your strategies with absolute legal confidence.